I do want to start with a quote. I'm going to throw you guys off real quick. I said I was going to take a minute, and I'll take maybe 45 seconds. But last year, when the chaos was really ensuing, I was like searching for confidence through our team, from my family, from my community. And I came up with this prayer that and it's like a wisdom prayer. And it's from a gentleman named Reinhold Niebuhr. I'm going to butcher that last name. Originally published in 1951, but it's called the Serenity Prayer. Maybe you've heard of it. It said, God, grant me the serenity to accept the things I cannot change, courage to change the things that I can, and wisdom to know the difference. And so I just start us off today with that because the world has changed a lot since last March. It's still a very interesting and can be an emotional place to live. But today, our purpose of this webinar is for you to get to know us better. Many of you already know us pretty well. Maybe one of us or two of us, or I don't know about all five of us. That's lucky you if you do. But today we will be listening and hearing from some of the leaders of intelligence-driven advisors that has several different origin stories, which is pretty fun, which we'd love to share with you at a different time. But starting probably first with, I'll start with maybe Jim Papillo. We met Jim almost 3 years ago and have since joined forces, and he leads up the team there in Scottsdale as an incredible contributor, works with many, many clients all over the country. And then Rick's story starts even before then, right, with formation of what we are today. Obviously, son Jason Labrum, who's our founder and CEO, and then recently joined, and probably the most recent join is Andrew, right around the same time as Jim. And Andrew gets tasked with the wonderful task of herding us and corralling us and keeping our collaborative spirit alive and well. And that's what today is going to be about. We're going to hit on the things that you, the listeners, the audience, the clients have asked us most about. We actually did a survey recently, and we asked our own clients what they want to hear about the most. And they told us the things that we're going to talk about today. So I'm going to start with something here, and we'll get a little bit interactive. I'm going to do a poll. It's my first one, so hopefully it works. But I'm going to click a button. I click the button launch, and a question should have shown up on your screen. Click whatever you think is the right answer. This is the Jim off, and it's talking about inflation. So go ahead and click that. At the end of the thing, I'll tell you what the results were if I can find them.
The host and panelists can't vote, darn it.
Yeah, you can't vote.
Oh,
sorry.
Man.
Yeah. And with that, I will share my screen, and Jim will get started here. You can still vote if you want, Jason, but you don't want to sway the audience, though.
Yeah, right.
Yeah.
Very good. Do you want to wait till the inflation results come in before I start?
No, please go ahead and get started.
Okay.
Yeah, we'll report the results back later.
Okay. Regardless of what the survey says, we want to talk about inflation, and certainly it's something that's on our minds and probably on your minds as well. And despite rising inflation pressures, what does that mean for portfolios in the stock markets, capital markets across the board, and of course, most importantly, your portfolio in either achieving or maintaining the lifestyle that you desire? So this first slide is showing corporate earnings, and corporate earnings are actually rising, and they're 14% greater than what estimated earnings have been forecasted to be. On the next slide, you'll see that earnings expansion, which is illustrated here. You have the stock market going up, you have earnings going up, and earnings are going up faster than prices of stocks are going up, which is causing the price earnings multiple, or the value, the affordability of stocks is still going down. So despite the fact that we've had this strong, robust market, the pricing of stocks still remain attractive. And we're just showing one example of the S&P 500. If you look at the difference between the S&P 500 price earnings multiple, or the affordability of stocks, and you compare that to international stock markets, the stock market here in the United States is at a price earnings ratio of about 21.4, and the international stock market is at 14. So this is indicative of why we start backing off a little bit on our domestic exposure and start tactically weighting a little bit more towards international as well. So what about this inflation? What about prices rising? What are corporations doing? Well, interestingly enough, corporations are able to pass the rising costs of goods and services to consumers. You may say, well, how can they do that? So if we look at the next slide, you'll see that consumers have been really subsidized by COVID checks. But interestingly enough, if you look at the upper right-hand corner of this chart, household debt servicing ratios are extremely low and as low as they've been in a long, long time, if not historically low. So the fact that we don't have a lot of debt, we've got more money, we've been saving money because we haven't been spending it as much because we're not going out, not traveling, whatever it may be. We have low debt, so we're capable of spending more money and absorbing those inflationary prices. And interestingly enough, if you look down below that, then you'll see here's another influencing factor. Household net worth has substantially expanded. So we are wealthier, we've got more money to spend. And so the stronger consumer balance sheets is what's allowing consumers to absorb these greater price increases. If you go to the next slide, we'll talk about, okay, so what are the economies doing? The economies are expanding. We have gone from red, which was the beginning of COVID. You see all the orange, red color, which is a detracting economy. It's just the economies are just, not doing well at all. And the green is obviously economies are expanding. And so here we are toward, 2021, that last column, economies are expanding across the board with the one country exception of Japan. And Japan is getting better. So there's an appealing economic expansion. There's a lot of momentum. It's mostly positive as the green boxes indicate. I think something else that's a little interesting is U.S. housing starts, 800,000 new home construction, and the trickle effect from that and the global impact on durable goods that are going to be needed to be purchased for those new homes, for furniture, interior design materials, and services, and the vocational contractors to come and do the trade work and other services and things like that. So mind you, the durable goods, they may be starting off to be purchased here, but they're manufactured in Vietnam. They're manufactured abroad. So anyway, we have a good environment despite inflation. I'll pause there.
That's great, Jim. Thank you so much. And I think this is the time where the panel, let's respond to Jim with the kind of objective of maybe talking to the audience about what this means to them and what they should do about it. Perhaps, who would like to start?
I'll follow up.
Jim, it's not your turn.
I just want to reiterate a couple points. Investing is a marathon. It's not a sprint. So it's a long-term exercise. And, regardless of what's happening with inflation or markets and so on and so forth, it's time in the market, not timing the market, that counts the most. I'll pause again.
I'll jump in there too, because what we've experienced is from our clients is lots of questions about inflation. So it's a real concern that's on people's mind. What are we doing? How is inflation going to affect our portfolio? And like most of the answers, when people say, what are we doing? We already started doing it long ago in the portfolio because we're constantly reviewing, analyzing, stress testing, trying to break the portfolios to make them better. We put our portfolios in front of firms like the largest investment company in the world, BlackRock, Dimensional, the most rigorous academic investment firm in the world, Parametric, and a host of other names. And we literally say, what's wrong with this portfolio, given the current economic environment and given our deeply rooted investment philosophy, what are we missing? So inflation has been something that we talk about a lot. And you've seen a commodities position come into the portfolio. You've seen some small tweaks happen to the portfolio, like Jim mentioned. We don't time the market. We don't sector rotate. We don't try and jump in and jump out because we know that that's a fool's errand. However, we have also learned over the years and the decades of doing what we do that it does make sense to pay attention to what's going on and make slight tilts. So if you think about a portfolio that has 10 or 12 different asset classes, we may tilt those up and down just a little bit given what's going on. So that's happening. It's in our portfolios and something we talk about all the time.
Let me ask Jim a question that kind of relates to this. I'm not sure what the answer would be, but it would appear to me that over the last 50 or 60 years during these inflationary periods, our economy has not only expanded, and that's part of it, but our portfolios have done well also. So there's a good and a bad thing going on with inflation at this time.
Yeah, I would say yes, it's accurate. And then Alex, if you're still able to move to the next slide, I think what's critical about what Rick said is we do have inflation, ebbs and flows of inflation, ebbs and flows of markets going up and down, and we've always known that, and that's not going to change. But how do you deal with those cyclical influences? And this chart here is looking at the different asset classes, and each asset class is a different color, and you're ranking them from the top being the top performing asset class that particular year. And of course, the bottom is the worst performing asset class that year. And what this shows you, and the reason it's in colors, is there's no one dominant asset class. It's always at the top, or thankfully always at the bottom. But the gray box is a diversified portfolio. So maintaining diversification, as Rick, to address what Rick said, inflation comes and goes, to address what Jason said, how we tactically shift a little bit up and down, but we're not trying to time the market. We just know that a diversified portfolio is going to get you from point A to point B, do it in the least volatile or riskiest way, and to keep you on track for achieving and maintaining the cash flow that you need to maintain your lifestyle.
And this is a perfect segue. I'm going to go to the next. I'm going to show you the poll. Sorry, Jason, to cut you off.
That's okay,
I want to make sure we keep on track here. Yep. So this is the results of our question here. What do you think inflation will be in 2022? Huge question. Don't know the answer, right? Interesting to see the kind of scattered thoughts on 2.5 and then 7+ actually, but most people seem to fall right here into the 5% mark, right? Not a lot of choices here. I understand I could have given more choices, but I think the point of this question is, do we feel like inflation's here? Yes. Is it going to be here next year? Probably, right? Okay, let me
and Alex, if I could make a comment on inflation, just looking from a 30,000 foot level, I think there are a couple questions people have. One being, are we looking at what happened again back in the 70s and the 80s in terms of inflation? What kind of structural issues do we have, right? That being supply chain. I think we've all noticed how fragile our supply chain is when it's cut off for a certain amount of time. I think this is going to bring back a bigger question of how much manufacturing is actually brought back to the US as opposed to overseas. When you think about chip shortages, we have US companies like Intel now building larger factories here, which won't be online for about 3 years. So there are things that will be sticky in terms of inflation. There will be wage inflation that's already happening right now. So I like to relate it back to the portfolio and kind of go back to what Jason said. We have positions in the portfolio that typically do well in inflationary periods, and they have been in the portfolio for quite some time. Let's take just a quick, let's talk about a factor just with quality that Jim alluded to that as well, where companies can pass along prices, right, to not affect their margins. This helps with earnings, right? So we have specific factors which are characteristics of stocks that we see exhibited throughout time. Another one of those being areas like in high yields, right? We have a position called Fallen Angels that has roughly 25% of its holdings in the energy sector. Energy's done very well this year, right? So we also have a commodities position, which Jason had alluded to. And then you'll find some parts of our active management actually have tips in them, right? That being our PIMCO income fund. So there are plenty of ways that we can fight inflation with our portfolio specifically, and those have already been in the works for quite some time.
Yeah, that's good. Thank you. Right before we logged in, I clicked Yahoo Finance because I was just curious, like what's the market? People ask us what that means. And then I say, what do you mean by that? Is it the Dow is the market or all these different things on the screen here that Jim shared? But it's the segue I'm trying to make here is on to Rick's part next. I'm going to launch another poll because many markets, I should say, are at all-time highs, right? We just talked about inflation for a little while and what that might do. Click launch. Hopefully it worked. You guys see the next poll here. Market correction. This is a really fun one, right? what would you do if the market goes into a correction in the next 12 months? It would make sense to, this is for all the audience, so click away. I'll leave that going for a little while we pivot over to Rick to talk to us about alternatives to bonds in a potentially challenging environment. Rick, the floor is yours.
Yeah, thank you, Alex. There's no one strategy fits all, but and just the previous conversations touched on a couple of things, but in interest rate, I'll give you just 4 or 5 strategies based on client goals and objectives, but private equity, private credit would be one place we might go, and that's an alternative that is just private financing away from the public market. Another would be real estate, which Jason will touch on a little bit later in our program. And then that's also a good hedge against inflation as well as low interest rates. And annuities provide us with guaranteed income and fixed income. If that's a concern with clients, there's offsets there as well. And you can replace fixed income with commodity. Again, something that Andrew just touched on that helps with inflation and it helps with interest rate to replace bonds where we're not getting quite the returns we're looking for. Also, you can expand your existing fixed income and get more aggressive on that by chasing some yields, which isn't necessarily a good idea. Reaching for yield in a low interest rate environment is always going to be add additional risk and liquidity problems to your portfolio. But remember, the most important thing about low interest rate environment is remember why we have bonds in our portfolio to begin with. And that's everybody needs something to help offset those down markets and gives us exposure to bad sides of the market from time to time. So the reason for holding bonds is usually driven by client goals and objectives. So some clients need a lot more bonds, some clients don't need the bonds. And I just always discourage people from reaching for yields, which I've done myself in the past. And the portfolio is always going to experience deeper sell-offs than you would expect when you try and go for junk, because they act just like the stocks in a down market. So another idea is in some cases, a client can increase their equity holdings and then offset that with kind of a barbell effect by going to the fixed income side and just using treasuries, high quality corporates, equity diversifiers. But your total bond income or bond or fixed income returns may be even a little bit lower than they could be if it's possible right now when you do that and go with strictly treasuries, which we've seen in some of our positions where you're only getting 0.5%, and even sometimes you might even lose a little bit. But again, I would always focus on the goals of the total overall portfolio and not get distracted by low interest rates or inflation. And like Jim mentioned, you've got targeted returns. That's what we want to shoot for, and we want to do it, give you the best returns with the least amount of volatility and exposure to risk.
That's awesome. Thank you. And then who would like to respond to Rick or maybe ask him a tough question?
Oh, I think that I'll just jump in real quick. We have all the asset classes and most of the alternatives that Rick talked about to bonds in your portfolio, with the exception of annuities, and some of our clients own annuities where it's appropriate. So again, I go back to we've already done it, right? We're on the front end of this. We're constantly, daily evaluating whether our portfolios are structured correctly. And so we don't want to go make some gigantic move because we think inflation is going to be larger than normal. Here's a story that I experienced personally. I was with a group of friends. We were sitting down at a dinner table. One of them was a financial advisor as well. And I'll tell you the time in a minute, but he was adamant that inflation was coming and his portfolios were all set up for inflation. He'd moved every position, totally reset up the entire portfolio. And I said, man, that's crazy. Inflation's coming, because at that time there was no representation of inflation. And he says, it's just obvious. You just look out there, you just see it's going to happen. Interest rates can't go down. Inflation's coming. I said, I'm not that confident, because it's really tough to determine whether inflation's here, going to stay, going to leave, come and go. It's really tough to predict markets. It's easy to say what's happening today. That was 7 years ago, right? And it wasn't until in the last 12 months we started to see this inflation and started to see things turn around. And most of that was a direct response to COVID and supply chain disruption. So, again, trying to predict whether inflation or interest rates, what's going to happen is a fool's errand. We have to instead build really solid, diversified, well-structured portfolios. And I think that's what we're doing for our clients. But Rick, also, I think you had a slide, or we were going to talk a little bit about just the returns of equities during. There's a slide, Alex. I'm going to give you the page. Sorry, I'm slow. The returns of equities during down years or high inflation years. It's 12 of 18. And this is just always interesting to me when you pull the data, because the data always tells you and leads you to, when you look at data, how you should have invested, which is not be emotional and try and time it. So check this out. Any thoughts about that, guys?
My personal belief, right? We haven't really seen much inflation since '09, right? And that happened mainly due to kind of things starting back up after the great financial crisis. What we have in our portfolios right now is we are currently overweight equities. So in a 60-40 portfolio, you're really 64-36. So we are trying to take into account that sort of scenario, Jason, that you just painted as to what's happened in history, right? Equities have done well. So we are currently on a strategic basis, right? Overweight equities. When it comes to alternatives to bonds, kind of like Rick said, there's sort of certain circumstances where this works well for specific clients. It doesn't work well for the masses at times. So it's something I would implore you to talk to your advisor about. But you can find additional yield. It might come at additional risk or an illiquidity premium. So I would think it would be a good idea to discuss that with your advisor.
I would like to add, as it relates to inflation as well, is does inflation, really matter to Americans? I mean, we are the wealthiest country, and I showed a bunch of statistics and data that said, oh, look, everything's good. However, there are things to be watching for and things that we look for on our radar screens. And the one thing that concerns me is, number one, if any of that previous data that I displayed changes, so we have to watch in those metrics that we talked about. I also, what's concerning for me is that when we have inflation, it may not impact most of our clients or most Americans, but the lower wage earners, them going and buying groceries, a loaf of bread, a gallon of milk, or gasoline at the pump, that's a huge tax for them. When you have gasoline that's going from $2 to $5 or up, I guess, upwards of $6 in California, and somebody who's living paycheck to paycheck, what's the ramifications of that? So I don't want to paint a scenario panacea here that, we do have here at IDA, we do have our eyes on the radar screen and looking for things that where this data that we've talked about can change. And then also, what is the impact going to be as inflation? If it can stay around 2%, which is the Federal Reserve's target, we'll be okay. If it starts going upward of 5%, like many people answered in the survey, or we had a pretty good polling of people that said 7%, there are concerns there, which gets back to why we do what we do and what we've been talking about on the call.
On that note, too, I'm going to share the results of the poll. If the market go well, if I hit share, you should be able to see it, I think, right? And again, my first time doing polls, so hopefully what I'm saying is happening on your screen. But if the market goes into a correction in the next 12 months, it would make sense too. And by a landslide majority, which means we have very good communication with our clients and whoever's on the call today, hopefully maintain a disciplined rebalancing strategy that matches my investment strategy with my personalized financial plan. This is the cornerstone and the key component of every client relationship we have at our firm across every advisor, every office of IDA. And that is to start with a personalized financial plan. And from that stems the investment strategy. This is going to be an interesting kind of dovetail from Rick's talk on alternatives to Jason into real estate specifically, because Andrew alluded to a little bit. There are some things you can do outside of public markets, but is there a process you can follow to get consistent returns? And I have this little thing on we all should have this probably, right, guys? If you have them, hold them up. If not, then maybe it's on the other office. But our purpose as a company is to steward true financial peace of mind for all. To me, one of the things it means to me is that we have a way to do things where it's a consistent story to you, so that you don't wonder what your next review meeting with your client, your advisor is going to be like. And there's no big surprises like, oh, we did that thing and it didn't work. It doesn't work like that, right? So anyways, that's my kind of dovetail into real estate for Jason. I'm going to stop this poll. I'm going to start one more poll. So hold on one second, Jason. Just let me hit this thing and see if I can do. Here we go. So this is a fun one. This is an advisor's job. What is our job, in your opinion? I know that there's only 4 choices. I get it. It's kind of a stacked deck when it comes. I think we had one attendee put a comment in last time. We missed the option trying to time the bottom. It wasn't on there for a reason. But what is what is the advisor's job? And so as you're responding to that poll, Jason, please get us started on real estate as an investment solution.
All right. Will you pull up the slide 8, please?
Yes, and thank you for telling me which one. This is the part where I make the joke that when we first sent this out, I said, okay, guys, here's all the topics. Here's your topics. Okay, we drew straws on who's going to talk about what. I got 64 slides back. 64 slides. I'm like, I don't know how to do that for 2 minutes each for 64 slides. Thanks, Andrew.
It was
that was a condensed version, right?
It was not going to work.
Yeah.
I want to remind, not to take your job, Alex, but I want to remind people that the Q&A tab on the bottom is an awesome way to engage and give us topics that are of interest to you. And so please, feel free to do that. I see a couple questions coming in on the Q&A, and that's a great place to do it, where we can either type in an answer or we'll answer it live. If you don't mind, Alex, of course, I'm going to go off script because I'm so bad at scripts, but and I promise I'll be less than 20 seconds. But, we had a question, does inflation really matter? Gasoline in the U.S. at $3.50 per gallon represents less than 10 minutes work at $30 per hour. Really interesting way to look at it. I like that. The question goes on to make a statement. When I started driving, gas was 25 cents per gallon, which would represent about 10 minutes work at $3 per hour, $6,000 per year. So, if inflation is happening and the cost of goods are going up, are you probably making more money to adjust for those costs of goods going up? And is this something to even be really worried about anyway? I think the question is great, and I think it presents us with the Venn diagram that we use so often that says, focus on what you can control and focus on what matters. And where those interlap is the time the place to spend your time and energy. And look, does it matter? I think we got to be aware of it. I think we got to know what's going on. Do you go aboard an investment philosophy and change everything you're doing because there's inflation, or lots of inflation, or a little inflation, or you think there may be? I think the answer is no. I don't think it really does matter in the grand scheme of things, as long as you have a well-diversified portfolio. So I'm going to talk about real estate now. And one of the things that we've done, I think many of the attendees on the call know, we have a real estate fund. It was called Invictus. Invictus is where we invest in private direct real estate. We buy multifamily apartment complexes and we value add them. Means we fix them up, and then we re-rent them, and we create value in that property because we're able to make the rents a little bit higher. We're able to make the property better, create pride of rentership, and make a place that is nice for people to live, that they're proud to go to. So we've done that with some success over the years. We're considering how to continue to do that in a private fund format. There are also other direct ways we're putting real estate into clients' portfolios. This is a kind of a customized feature within a client's portfolio. We are working on how to make this across the board, but there's some issues with making it across the board because some of the funds we use are semi-illiquid, meaning that you can only sell them on the quarter. So once a quarter, you can sell the fund and get your money back, and they can even put a gate on that and say you can't get your money back because more than 5% of the fund was trying to redeem. So there's some illiquidity issues, or you might call them illiquidity premiums, because when you invest in a investment that has illiquidity, oftentimes there's a premium, you get a better return. So what we're talking about here is direct real estate and it being private, meaning it's not a REIT that you buy on the public markets. You are investing your capital alongside other investors and buying multifamily, industrial, maybe office, and different things. And so, as you see from the slide here, real estate typically has had a higher income than bonds. It has some distinct tax advantages. There's typically lower volatility, especially in private real estate versus public real estate. You get capital appreciation, and you have characteristics of both stocks and bonds. So we like real estate as an asset class. Alex has been interested in this, and he runs Invictus with me. We've liked it for a long time. We continue to like it going forward, and we think it can be an important part to somebody's portfolio. If you scroll down a little bit there, Alex, I think you'll see another part of this slide where when you put 10 to 20% of a portfolio into private real estate, I'm not talking about REITs, publicly traded real estate, private real estate, you can see what happens to the annualized return as compared to a traditional 60-40 portfolio. Not only does the return go up, but the volatility goes down significantly, possibly by up to 30%. So we think that this is something that we should do more of, help clients do more of. You don't have to go out and own a property individually. You don't have to go change the water heater. You don't have to go deal with that individually. You can do that in investments that are available to you as our clients. And I know I'm probably up on my 2 minutes and over it, so I'll stop there. But if I can add just one more bit is the real estate, well, I'll just stop there and we'll open it up to the panel for questions.
What's the minimum investment on that real estate, Jace? Is that a fair question, or is that?
Any question is fair. I mean, yeah, 25,000 is the minimum investment on
okay.
On
the private equity.
Some of the investments that we're using that are called interval funds and have quarterly liquidity. Yield on it is about 5.25%, and the average return has been about 7.5%. And so, as a replacement to bonds, if you're if I'm the lead advisor on your relationship, you've heard me start to talk about this a lot, and I'm working with Andrew, who's director of portfolio management here, as to, trying to get that into everybody's portfolio that it's appropriate for, and do it in a way that's efficient. I do want to talk just for a second about private real estate. There are, I've done probably to the tune of 75 to 100 different financial plans where I'm analyzing the specific real estate held by clients of ours, where they have rental properties. And in almost all cases, it doesn't look good. It's better for them to sell that real estate and invest it in a traditional portfolio. And a lot of people get frustrated with that because they love their real estate. And they say, I'm getting $5,000 a month in income. But of the $5,000 a month in income, they're spending $4,300 of it to pay the mortgage, to pay the HOA, to pay the landscaper, the gardener, and so on and so forth. So the reason why that doesn't work as well in an individual one-by-one properties is because people don't do it correctly as individuals. They don't maximize the leverage. They don't have scalability and efficiencies through size. So those are some things that we can do for you, is run specific real estate analysis to see if you do have rental properties, is it the best way for you to own real estate?
And this might be a part where I too, just because it's such a big topic, and Andrew's probably smiling right now, or smiling in his head. I think it's important for people to know our philosophy on how to approach this, right? So there's efficient market hypothesis. We talk about this a lot. Some that sound like DFA. Markets are efficient. Don't try to game the system. We're really good at that.
Yeah.
We're really good at figuring out how to put together publicly traded securities. It's the core of our being, right? but does it make sense sometimes to go outside of efficient market hypothesis and try to find things that are asymmetrical? It's an inefficient market. You know, you and I could both go look at a property together, and I might know something that you don't know because I just know more about the property, and you might bid on it with the information you have, and I might bid on it with the information I have, and I know something you don't know. It doesn't exist that way in public markets, in our opinion, right? So it's a really interesting thing to have that philosophy in play as we make decisions. I think it's good to maybe flesh that out. I'll put you on the spot, Andrew. I mean, how does IDA approach the topic of due diligence and using private real estate for clients versus publicly traded securities that might actually accomplish the same thing with less risk?
Good question. So typically when we get into areas like this where it's an alternative position, whether it's private credit, private equity, or real estate, and let's just stay with real estate for now. When you look at what happened in the great financial crisis, right, of 08, 09, you saw public real estate was down about 50%. Private or direct real estate was down roughly 20, okay? Let's look at COVID. COVID, direct or private, was down about 10%, while public REITs were down 50%, okay? We know everyone's home values have gone up over the past, couple of years, a significant amount. But when it comes to the due diligence, right, we look at the managers and what they're, we look for typically top quartile managers because the difference between them and everybody else is extremely substantial, right? We're talking, you are investing in this specific fund that Jason is discussing, along with some of the largest private equity real estate investors in the world. We're talking massive teams who are doing due diligence, have hundreds of people on their team looking at every single deal. And I think their track records, not based on performance, but by the shifts that they have made in these specific areas of real estate. One being industrials, office parks, and specialty and life sciences, right? This is a fund that saw a lot of these changes happening well before COVID happened, right? They got further into industrials and warehousing. Let's think about how many warehouses somebody like Amazon needs today, right? They're about to hire 250,000 workers for the seasonal event that we're about to go through here. So these people they're able to foresee what's going on, where the shifts are happening, and they can make that happen pretty quick. So those are the managers that we look for.
Yep.
Awesome. Thank you.
And the slide you have up is awesome, Alex, because it just gives you some perspective. Again, we always look for historical data. We look for academic evidence. We look for proof of why we would want to own an asset class. And you can see the private real estate is the IPRE. And you can see how it's performed over 5 years, 10 years, and 20 years. What's I think the most interesting is just look at the longer term, the 20 years with an 8% rate of return. But look at the volatility as compared to REITs of a 4.16 standard deviation versus a 22. So you're talking about taking, is that 80% less risk and achieving almost the same return as a public REIT. This is an asset class that, as Alex alluded to, it's really important that people understand the difference from efficient market asset class and public markets and private markets. It's why if you go invest in private equity, meaning buy companies that are still private, there's arbitrage, there's opportunities to have mispricings and information, and it's not a terribly efficient market. It's getting more efficient. That you can derive higher returns in those marketplaces. You deal with, there's trade-offs though. There's illiquidity, there is more risk, there's more potential volatility, especially in private equity. But this is just another case of something that I think you got to be paying attention to, you got to be thinking about, and we're trying to make it part of most people's portfolio.
Yeah. There's no way to segue to this next one from what we were just talking about,
yeah.
but I will point out that I put the wrong poll in the wrong order, so that at least you can just draw attention to that. I'll share the results. I'll share the results with you now from the advisor's job. This is supposed to go at the very end, but it's okay. I think it's still a good effect, anyways. But and again, I mean, I know it's starting to get kind of a pattern is forming here that the last option is supposed to be the right answer. I do like how some people though were like, no,
I'm going off the rails.
Yeah, an advisor's job is make me money no matter what the market is doing. That I admire those two that put.
I hope that's Jim or Rick's client, not mine.
Call Andrew; he'll figure it out for you.
And to know when the market's going up or down, we know it. If we actually knew exactly when that was going to happen and when it would stop going down or when it would stop going up and going back down, we probably wouldn't be working.
Well, we know for sure that it is going up or down.
Yeah, that's right. That's what they meant, I think.
But it's interesting to say that, right? Because some people would say, well, then why do I need you? Well, because it used to be people hire advisors because they had information. This was back in the day, right? You hired a broker because the brokerage firms did the research. They had information and they were studying stocks. There was no internet. You couldn't trade on your phone. You couldn't make a trade. You couldn't get information about stocks. You didn't look at Yahoo Finance. People went to big brokerage firms because they wanted to get information. And there was some inefficiencies in the market 25 and 30 and 40 and 50 years ago. Those inefficiencies have all but disappeared. And they've disappeared because of the internet, and the flow of information is now instantaneous. And there's hundreds of millions of market participants who are smart, some not so smart. There's algorithms, there's computers. This information is exchanged instantly. Therefore, the markets became more efficient. So it's now people go to advisors like us and to our firm because not to get that one bit of information. You could probably go find it. The problem is you're going to go find billions of things of information. You're going to find so much information that how do you decipher through that? What's financially toxic, what isn't, what is useful to you, and how do you build an investment philosophy and stay with it? So it has changed. And I think I want to just talk about that because as we recognize and admit, we can't forecast the market with accuracy. We can make tilts, we can build great portfolios, and we can help you have a phenomenal outcome and a very peaceful journey doing it. To try and do that without the team that we have would be very difficult. It would be hard. So
we have a couple of great questions from attendees, participants. One of them, which Jason kind of plays off the real estate that you have just been talking about, is what's the impact of online commerce relative to big box stores and big malls and things like that? I have just a couple comments as it relates to that. I mean, one of the things that we're seeing as relates to some of the things that you talked about, Jason, in the real estate, the private equity, is this, some of these malls, people are going in and buying them and converting them to assisted living facilities or whatever type of
multifamily, industrial.
Yeah, multifamily. So I think that's an interesting trend. The other thing, which I don't know too much about, it's kind of interesting to see the biggest online consumer, Amazon, now going out and starting to buy brick and mortar. So I don't know, where it goes. I think there's always going to be a place where people want to go and touch, feel, try it on, type of a thing. But there is a lot of transitioning going on. Any comments from anybody else on the panel? And maybe start with you, Jason.
I agree. I think there's so much change in the place, but there's a limited supply of buildings that are built. There's codes, there's red tape and things you have to go through to build them. So real estate's always going to have its value, but it's certainly changing. And I personally am not a huge fan of office real estate. We own some. Personally, I own some, but I think the office environment is really going to be different going forward. I think the amount of people that go back to work full time the way they used to go to work at an office will be changed forever in a way that I don't think we know the impact yet. I think that the online and the big box gym is here to stay forever. You need warehouses. I was looking at we own a real estate project called it's a GTIS is the manager, and they have they're doing these mini warehouses. They're like drop shipping warehouses, and it becomes so critical because they put these right near, highly dense consumer areas where Amazon trucks are dropping off stuff, or UPS trucks or whatever, dropping off packages. So what they do is have the big trucks come in and drop ship in their warehouse, but then literally that same day it's forklifted back out to the small trucks. So it's that kind of stuff is really interesting, and there's some great investment opportunities in that area, I think. And then I know before we get to the last topic, Alex, there was another question I'll just hit real quick because I'm pretty familiar with it. Is a question that came up about ETFs related to Bitcoin and just Bitcoin in general, and inflation around Bitcoin. I have a quick spill on it. Bitcoin is interesting. Blockchain technology is what's behind Bitcoin. Blockchain technology is even more interesting than Bitcoin itself because it really revolutionizes the way transactions are made and can be made. And so my concern about Bitcoin itself is that it's like buying the internet. Had you bought the internet, right? It's not the internet that did so well. It's the companies that utilize the tool of the internet. It's the Amazons and it's the Intels and it's the Microsoft that use the internet. I feel like there will be companies that exploit blockchain technology, and they will be the companies that are the true benefactors of blockchain. Does Bitcoin become a currency that is relevant and used every day? I don't know. I think the governments are going to fight it very hard because it takes away the ability for governments to manipulate their currencies. That's why China has already outlawed it, because China is one of the greatest currency manipulators of all time. They don't want Bitcoin involved because then they can't manipulate their currency. So I think Bitcoin as a currency has a long, long, long volatile road ahead. I think blockchain is being introduced and used by some great companies already every day, and there are ways to invest in that. We own it in our technology fund. In your portfolio, if you're a client, you have pieces of that right now being in your portfolio.
What was the headline that came out yesterday? It was, who's the Packers quarterback? Oh my gosh. Aaron Rodgers. Rodgers decided to accept part of his salary in the form of Bitcoin. Did you guys see that?
Hey,
and Bitcoin hit an all-time high again. I'm like, come on. But it's interesting.
Yeah, and Jason, just to dovetail off of your comment with this ETF, this new ETF that came out, it's a futures-based ETF around multiple cryptocurrencies. And one of the things that worries me about that is futures contracts and ETFs that hold them have the ability to have massive leverage, right? We have a commodities futures fund where all of the futures contracts are held in some kind of cash alternative. So every single future contract that we own in that ETF, it's that money is parked on the side. So there is no leverage use. That is the one thing I would be extremely concerned about using this new Bitcoin ETF.
Yeah, agree.
Okay, I'm going to do our last poll here. This is great. We're actually going to be on time, I think, which is kind of a miracle for us. But this last poll, and this poll, while we're letting people respond to it, it's a poll about volatility. When I think about market volatility, and then there's the four choices. And I think the last question, or the last option on this poll actually answers another listener question on the Q&A. Thank you for sharing that. That's my favorite part of what we do, actually, is what your question asked is how do we make decisions, and how do we show you that you should have peace of mind? And so the first thing we do with almost every client, I hope every client, is listen to you and learn and build you a comprehensive financial plan. It takes into consideration your income, your expenses, inflation, right? Assets, liabilities, the whole puzzle piece. And then from that, it's how we get to know you. It's kind of how a doctor does a physical first and does a bunch of unnecessary tests, or they seem unnecessary, but that's how they diagnose how to make you better. And also to set a benchmark on, okay, this is what you look like right now. Here's where you want to go. We can check in every quarter or every 6 months, and we can stress test. So using data and analytics and 25-year history of actual market volatility that's already happened, COVID, 2008, all these major market events, and we can throw the Monte Carlo stress test at it every single time, reconfirming your investment strategy, reconfirming that you're on the path to succeed. that's something that is, it's our desired client experience. And so if anybody wants to hear more about that offline, that's an excellent way to start a conversation with us, or to reconfirm that that's what's actually already happening with you, because many of the attendees on this are clients and many are not. So good question. Does anybody want to add to that before we let Andrew talk about Biden's tax plan?
Yeah.
Sorry, I'm laughing, Andrew, but you got the short straw, I think, on that one.
Alex, I love what you say about the planning process. I mean, I think just one quick add-on is it's not a 300-page binder we give you full of a bunch of useless information. Our financial planning process is designed to be interactive. It's designed to be dynamic, and it's designed to move with you throughout every stage of your life, as we are your financial coach, helping you make the best financial decisions you can possibly make. We have a login to that and a portal, so you can log in and see your financial plan. You can log in and see your accounts. And then upon every review that you have with your lead advisor, you should be talking about the performance and the results of your portfolio and how it worked as related to your plan. That is what has been the cornerstone of what we do. So I think it's critical in the process, because it helps you eliminate making those emotional decisions when they do run high, which they run high for all of us. When markets get volatile and your portfolio is down 20% temporarily, or 25 or 30, there is no denying it's an emotional time frame, and you have to make the right decisions at that time. If you make the wrong decisions in the heightened emotional times, that is what blows up investor returns. And it's why the average investor does horrible in the markets, because they make emotional and behavioral blunders as it relates to their investment portfolio. Planning is critical.
89% of everybody said what you said. Option number 4.
Good.
I like the number, the one person and the 3 people that actually were kind of just thinking about it and literally speaking, which is, I appreciate that. It's literally off our management agreement, but totally. All right, Andrew, the floor is yours.
All right.
Biden's tax plan.
Okay. Biden's tax plan. So I think most people have been asking this question about how is this going to affect taxes? Right. The latest iteration that came out on Thursday last week for the Build Back Better plan was unveiled. It was roughly a 1.75 trillion social and climate spending plan. About $1 trillion of it would be financed through higher taxes on the wealthy. Americans who earn more than about 10 million in income would be levied a tax surcharge, and households earning less than 400,000 a year really supposedly are not going to see an increase, right? As of now, this doesn't raise the top current rate of 37% or the 20% top rate on investment income for now. So again, a lot of what is happening is it's like trying to hit a moving target at this point. So we will not know until this deal is finalized exactly what is going to come out of it. There are a couple other nuances with this, one being Medicare surtaxes, and then how is this going to affect businesses? I think that is still yet to be seen. So again, hitting a moving target, hard to figure out what is exactly going to come out of this, but it's a pretty good fight right now between both sides of the aisle. One thing I would say is, how does this relate to our portfolios, right? If you are in that category of someone who is earning $10 million a year, congratulations. That's a pretty awesome income to have. So for the people that might not be there, but are potentially faced with higher long-term gains, we obviously have strategies that we take care of here, which are tax loss harvesting. Right, that's one way that we try to mitigate taxes as much as possible. Within our portfolio, we look for the most tax efficient positions to put people in. A lot of that being ETFs typically tend to have a better tax efficiency than mutual funds. A lot of the time we have to look at what the returns are and what you have been taxed, right? Whether it comes in the form of cap gains. So we're always monitoring that. For certain circumstances, we do have the ability to look to separately managed accounts for clients where we can get much more aggressive with tax loss harvesting. Those are some things that we've implemented for specific clients based on certain needs. A lot of these come with a minimum and specific criteria that they would need to understand prior to investing, almost along the lines of an alternative strategy. But again, we're not going to know until something is signed and done. And there's a lot going on both sides it's a big push and pull. So we'll see. Stay tuned.
What about questions now from?
Some of the questions actually that are coming through have to do with the real estate. Maybe we should just answer them in a blanket answer so that people wonder. So the Invictus project that Jason mentioned earlier in the webinar was something that we launched basically because of client demand. It was launched back in 2016, and we actually had to close it to new investors in 2018. So it is a closed fund that has been closed for some time. We are in the stages of, as Jason alluded to, creating a new fund or series of funds because there is so much demand. We are obviously very cautious as we proceed because I would say we do have a philosophy on this type of real estate as well. We like multifamily value add real estate. That's why the commercial real estate thing doesn't even hit my radar, at least. I know it's good that we hit on that, but like when we do a private fund, I don't think we would even consider buying commercial real estate. It wouldn't even be something that we would do. It kind of gives you kind of an insight into how we think about real estate as it parallels to our strategies, our publicly traded strategies. We want to diversify away risk. We want to be able to have some levers. Multifamily value add has an opportunity to do that with illiquidity, of course. But I hope that answers most people's questions. You can't invest in Invictus today. Sorry.
But there are other opportunities that are available in our portfolios today. So
yeah, absolutely. Yep.
Yeah.
Other questions? I think we're coming up on the hour. I will say this though, to keep people wanting more. This was again, this is something that a lot of people were asking us to do. It's why we did it, and the recording will be made available sometime next week after compliance goes through it. Make sure it's all good. I think it is, but just in case, we'll give it a week. The other thing too is that we are going to have another webinar hosted by someone else, or we're going to host it and he's going to come in as a guest speaker. It's a really cool topic. It's actually nothing to do with investments at all. It's positive psychology by Brad Seaman, and he actually borrows some of the I forget the name of the gentleman. I don't know if you guys remember offhand, but a famous author on this and speaker. But he's going to talk about positive psychology, and it's something that obviously a lot of us could have benefited from a lot last year. Still today. And with the holidays coming, I think it's a pretty cool thing to focus on. We're going to all be around family and friends, and some of us are, more positive than others, depending on what's going on with our lives at that time. And there's still a lot of strife out there, for many. And it's going to be December 14th, 11, same time, but December 14th, also a Tuesday. We like Tuesdays at 11 Pacific time, apparently. And so we'll send out something on that, and you'll have an opportunity to register for that and hear from an industry expert on positive psychology.
Excellent. That'll be fun.
Yeah.
Thanks, Alex.
Thank you all. Appreciate your time, guys.
Okay. Thank you.